Ladies and gentlemen, welcome to Real Estate Investor MBA. My name is Tejas Gosai, and I've had the honor of helping hundreds of investors achieve the American dream by creating generational wealth through real estate. I've spent the past few years interviewing the most knowledgeable experts I could find in the business to cut your learning time and conquer the hardest subjects in the game. Check out rei.mba, which my team and I have packed with over 75 interviews and free access to our real estate roadmap, webinars, and publications. If you're listening, I am rooting for you, and you're already on your way to financial freedom. Cheers and happy hunting. Yes, today we have Neil Bawa on our show, and I have been waiting so long to get this guy in the program. It's important that we talk about the issues that are going on today, look at the historical information of what our ancestors have done, even just over the past few years, few decades, and how we can adapt with our commercial real estate business, multifamily business. Anything that you're doing right now in real estate relies on information to make the right move, mitigate your risk. Neil Bawa, our guest today, is the mad scientist of multifamily. He is someone I've looked up to for years. I've been watching him. I manage a private equity fund. I've modeled some of my career after seeing him and his company. So let me tell you about Neil. Neil Bawa is a technologist who is universally known in the real estate circles as the mad scientist of multifamily. Besides being one of the most in-demand speakers in commercial real estate, Neil is a data guru, a process freak, and an outsourcing expert. Neil treats his $1 billion portfolio as an ongoing experiment in efficiency and optimization. The mad scientist lives by two mantras. His first mantra is that we can only manage what we can measure. His second mantra is that data beats gut feel by a million miles. Data beats gut feel by a million miles. These mantras and a dozen other disruptive beliefs drive profits for his 700 plus investors. Neil serves as CEO and founder at Grow Capitus, an iconic data-driven commercial real estate investment company. Grow Capitus, their 28-person team, acquires and builds multifamily and commercial properties across the U.S. with more than 700 active investors and over 2,000 reviewing our projects. The Grow Capitus portfolio currently spans across 10 states with 31 projects and 4,800 units. The powerful Grow Capitus brand has a cult-like following of data-driven investors. The result? Completed equity raises of $270 million for multifamily, mixed-use, and industrial acquisitions in the last 18 months, over 4,800 units purchased. And they're on track for another 1,500 units in the next 12 months. Probably the longest bio I've read, but worth it. Data, data, data. Something really neat about Neil is every year in January, he comes out with a report that tons of investors look for to base their decision-making on. I urge you to follow this man and stay online with us. I asked for the first interview after his report comes out. So without further ado, Neil Bawa, thank you for watching. rei.mba, check out all of our cool stuff. Thank you guys. Cheers. Hey guys, Tejas here. We have Neil Bawa here. It's been a pleasure reading about you, Neil. You are star-studded, incredible resume. So I'm just going to say that you are the mad scientist of multifamily, and you've dealt in hundreds and hundreds of millions of dollars and tons of transactions. Welcome to the show.
Thanks for having me on the show. Very excited to be here.
For sure. Some of our listeners are newer. Some of them are very seasoned. I would love for you to just start with currently what you're doing. I think you have some significant assets under management if you want to give us a good spiel.
Sure. I'm a technologist, a data scientist by profession, and I love applying the use of data science to commercial real estate. Portfolio is about $1 billion, 31 projects in 10 states, about 800 plus investors that are currently invested. Multifamily, built to rent, self-storage, industrial, and student housing are the 5 verticals that we invest in.
Amazing. And what specific areas are you in? What markets are you looking at?
Mostly what we call the smile of the United States, with the exception of California. So, Arizona, Utah, Idaho, and then Texas, Florida, North Carolina, Georgia are kind of the main states. We're in 10 different states, but those seven tend to be the key focus for us going forward, with Texas being the single greatest focus for me for the next 10 years because of what's happening with China. Basically, the return of manufacturing with China, the biggest beneficiary unquestionably is Texas, followed by Arizona. So we tend to look at those two markets more than any others.
I love it that you just kicked that off as our start here. So I did not think we'd tie the words Texas and China together in this interview. This just means you know a lot more than we're going to have time to get through today. So let's keep it super high level. There are people that are scared. There are veterans. There's people that do millions and millions in real estate that don't know what's going on. You're very analytical and you look at it everything from a global standpoint. I've read some of your stuff and I've seen interviews in the past. It is a crazy time right now. Today, it's November 2nd, and people are getting into the end of the year. How do you frame something like what's going on? How are you still purchasing properties? What are you doing for the future? Give me the spiel.
I'm bullish about the 5-year time frame for my country, for the United States, and I'm bullish about the 10-year time frame for the world. I think that what is happening today, and it doesn't seem like it when it's happening, is that we have two bullies, China and Russia, who are basically getting their butt kicked. And you will see that Russia, which is the 11th largest economy in the world, is going to fall below the 20th by the end of this decade. Because they basically are simply, their economy is being decimated. And, we've had 20, 30 years of complaining about the fact that nobody ever wants to work together. Nobody actually gets together and puts up with pain. Well, if you say that today, you're a liar. Today, 30 countries in the Eurozone, the United States, have gotten together to basically take the fight to a dictator who's murdering tens of thousands of people. And we have destroyed already Russia's economy. Obviously, the impact of that takes a year. But that's incredible news for any bully in the world that thinks that they can get away with this. So I think that that's great news for the world. Now, on the China side, actually, it really ties back to real estate, right? So the Russia piece doesn't really tie back to real estate, with the exception of short-term pain, which I expect to continue for the next 6 months. I do expect oil to continue going up in price and gas. So there's short-term pain there, but I think that the long-term news is good. And when you plan for the future, you can't just be planning for the next 6 months or the next 12 months. You should. I mean, that's our job. But you've really got to look at the 3-year, 5-year, and 10-year outlook. And I think that what's happening in Russia is astonishing great news for the world in the long run. It will come to be seen that way 10 years out. So what's happening to China, though, is much more relevant to what we are doing in the United States. And that is that there is absolutely shockingly extraordinary deglobalization occurring. So from the beginning of the 1980s, when China started its move, to 2015, those 35 years were the globalization, right? Where everyone basically said, we can buy anywhere, we can sell anywhere, we can manufacture anywhere. And that is breaking apart, and it's breaking apart hugely. If you follow someone like Peter Zeihan, Zeihan, you'll really, really understand how important that is for us. So in the United States today, we are seeing manufacturing returning, and it's not coming necessarily back to the US, it's coming back to the Americas. So it might come back to Mexico rather than the US, but it's still great news for us, because that means that the states that are bordering Mexico get an enormous advantages. They will need hundreds of millions of square feet of warehouses. So industrial, I think, will do really well in those states. And they will need a lot of manpower, because essentially that manpower, which now exists in China and Vietnam and all of those countries, some of that manpower basically has to come into Mexico and to the places that are attached. This is extraordinary. The other piece of it is that the world is now beginning to run out of key resources. So obviously the first one that we're beginning to run out of is oil. And I think that that's going to cause consistent inflation going forward. In the short run, that's horrible news for real estate. And we've already seen that, right? So cap rates are decompressing. What that means is they're going up, which means prices go down. We've seen, prices in multifamily adjust by 15%, 25% in certain markets for certain kind of properties. we've seen that adjustment happen. And then single family, which takes longer to adjust, is now on its way down. And I expect there to be a 10 to 15% correction there. These are good things because prices were too bubbly. They made no sense. When you get to the point where nothing makes sense, if it continues, it is going to blow apart in a massive bubble. So it's better that the market cool down and come down 15% than have a explosion, which basically results in 30%, because that 30% damages our prospects for 3 or 4 years out. Whereas a 10 to 15% decline brings the market back into alignment. So the pain that we're feeling now and the pain that we're going to feel in the next 6 months actually is preferred than a 2008 type implosion. But the good news on that is, here's the key piece for housing. This is my key mantra. The bad news is the good news. Okay. So today, and this is a number from yesterday, was published yesterday, investment into single family real estate in the United States is down 36.6% in 12 months, right? And the US needs basically 1.2, 1.3 million single family homes every year. And that's what we tend to build. So we're not overbuilding, we're not underbuilding. We tend to build about as many as we need. So if you're supposed to build 1.3 million homes and you have a 36% decline, that's a 450,000, single family home gap, that supply gap that you just created, right? And that gap will probably run into next year as well until interest rates come back up. So now you could have a 2-year or maybe even 3-year gap of 450,000 units. Well, that's going to create a shortage of 1.5 million units. And when we come out of this recession, which we should because our economy is very strong going into recession, we will have household creation that will be stronger than 2008 because the economy was very weak going into 2008. And still we had an amazing 12 years for real estate, right? So, but here the economy is much stronger. When it comes out, there'll be household formation. When that household formation happens and you were missing those 1 million, 1.2 million homes, people have to go live in rentals. Right. And so I'm bullish about what happens to rental real estate in 2024, 2025, 2026, because of what's happened in the last 12 months and what's going to happen in the next 12 months. And I'm willing to put up with the pain that I've already put up with and the pain that I'm going to put up with in the next 12 months.
Man, that was an amazing explanation. And I love it that you used the word pain because the sellers have to feel the pain. They have to reduce their numbers. And I think I love it that you said that because so many people are afraid of inflation. And I think most people are just like negative, negative, negative. But this is required, or stagflation takes place and all these other bizarre concepts. Before we get into the next thing, I want to go back to oil. When this happens, the natural gas industry in the United States also kicks up a bunch to try to fill in that gap. And some of these other factors in Texas is just the best state. Everybody's talking about Texas. Like no one can stop talking about Texas. And I feel like you've been ahead of that though, because some people, now people are going over there in droves, but 3, 4, 5, 6 years ago, it wasn't exactly the same.
Yeah, I mean, and here it's as simple as this. Oil companies currently are producing the highest profit in their history. So when oil shocks happen, it isn't all losing. There's winners and there are losers. Now, in the 70s, or maybe 15 years ago, so 2005, if there was an oil shock, it was bad news for the United States because the beneficiaries were Saudi Arabia and Iran and all of these other places. Today, we are the largest exporter of fossil fuels in the world. So when there is a supply shock, who's paying more, right? So the cost of gas in Europe is 4 times higher than it was at the beginning of the year. Now, yeah, obviously the gas is not coming from Russia. The pipeline blew up, right? So the big question is, what country is supplying liquid natural gas to the Eurozone right now? The answer is only one, the United States of America. Yes. Right? We have an LNG terminal in Louisiana, and all of the gas comes from Texas. So it comes from the shale patches in the Permian Basin. It basically goes over pipeline to that terminal in Louisiana, and there's ships leaving twice a day to supply Europe at 4 times the gas cost that it was in January. So imagine the profits that Texan companies are making right now. I mean, right now is the biggest party of all time. And it's a sustainable party because unless the war ends tomorrow, we're going to be selling extremely expensive gas and extremely expensive oil to not just the Eurozone, but to other participants as well. Because the Russian supply has been taken offline permanently. It's not gone for 3 months, it's gone for 3 or 4 years. So basically, as the largest supplier of oil and gas in the world, the United States stands to benefit. Now, I'm not going to talk about whether this is ethical or not. In the end, it's about markets, right? So we can talk about the pain that the Ukrainians are suffering for this. But the truth is, purely from a financial perspective, the biggest single beneficiary of Russia's attack in the Ukraine is the United States of America, and no one can dispute those numbers. Please just look at the quarterly, distributions that Chevron and Exxon and all of these other companies are doing. They're making insane profits. Like, the profits are well over $8 trillion at this point. Not a billion, not 100 billion, 1,000 billion.
It's crazy. It's beautiful. I love how big no one talks about natural gas with me. I lived in Pittsburgh and I watched the whole shale industry, hydraulic fracturing, everything go up. One of my friends is actually Toby Rice. He's CEO of EQT. And it's funny because years ago he was saying it. And I still remember, I mean, this is 15 years ago now, or maybe 12 years ago, but it's so nice to hear you tie that into real estate because people don't mention it. And it is a very important thing. Like the roofs, the asphalt, all these little things rely on that one commodity, and it does affect real estate a lot.
It does, and we've seen costs go up in the short term, right? So I have 700 million construction projects. All of my costs are going up, but what's nice is rents are going up. So I'm nervous about the fact that my construction costs are going up for certain projects, but what's really, really nice is to see rents go up, and they've gone up insanely in the last 24 months. I mean, the rental increases have been, in my mind, truly, truly insane. I expect them to flatten at this point. I don't expect much rent growth in the next 12 months, but that's okay. We're in the middle of a recession, right? So the benefit that real estate has in the middle of the recession is not that rents will go up. The benefit is that in the middle of a recession, very predictably, the United States does not build enough single-family homes. So the benefit is not during the recession, it is at the end of the recession when household formation kicks in again. And the moment it kicks in, people are like, well, where's those million homes? Okay, well, we can't go live there. Let's go live in rentals and build to rent. So the industry used to have one answer to that at the end of a recession, which was, apartment complexes. Today, we have two answers, which is apartment complexes and build to rent. And the more affluent people are saying, yeah, I don't want to go live in an apartment complex. I'm going to go live in a townhome, which is in a rental community. And that's really what build to rent is.
Yeah. And you've mastered this. So how many, you said 31 projects?
With 31 projects, of which I think 13 or 14 are built to rent, about 3 or 4 are very large apartment complexes, and the rest are very similar to the other folks that you have on your show. Apartments, value add, or apartments that I've built in the past that I'm just holding now for cash flow.
So, property management, how do you handle some of the, difficulties in getting the place up and running? You're dealing with, I'm sure, some construction delays and things
Yes,
like that. You're probably
absolutely.
pre-leasing your facilities. I don't mean to get so detailed, but can you share some of that if it's affecting you?
Absolutely. So, the biggest impact at this point is delays, right? So those delays are going away now because supply chain's getting better, but we've had a lot of delays. So most of our construction projects are running 6 months late. So that's the average. Some are running 12 months late, some are running 2 months late, but the average 6 months. On the leasing side, things are good because, the occupancy has been so high that our pre-leasing activity have saved us some of those 6 months, maybe 1 or 2 months have been saved because we were pre-leasing faster than we thought we were going to do. Property management really is simple today when you compare it to the first 4 months of COVID. I mean, that was horrible. That was incredibly bad. But today, property management is pretty straightforward when you have rent growth and 95% occupancy. Honestly, our property managers are doing a good job and God bless them. I never want to be a property manager. It's a really shit job.
It is.
So
those guys are God's work.
Yeah, they're making such a tiny percentage of rents where I'm making 30-40% of profits, right? So obviously it's a completely different business model, and I never want to be a property management company. But you know what I did, it has been very profitable for us. So property managers are making a very small slice of a very small slice, right? So if it's a $50 million project, we make maybe 30% of that, so it's a very big slice. They're making 7% or 6% of $2 million, which is the rents, right? So because of that, I never find the property managers really charge enough money. And people are like, property managers charge too much. And my answer is, you're crazy. They charge too little. So no property manager does all of the things that they tell you they're going to do simply because there's not enough manpower. So what I did was a while ago, this is 4 years ago, I created a team in the Philippines, virtual assistants completely owned by us with directors, with managers, with supervisors, all in the Philippines. And then I bolted that team, I call it the efficiency center, on top of my property managers.
Wow.
Right? And so they're not meant to replace property managers. That can't really be done. They're in the Philippines, right? So, but by bolting them on top of an existing property manager, I was able to optimize every property, right? And I was charging maybe $20,000 to each property for this team, $30,000 a year. But I was raising net operating income by more than $100,000 a year, right? Because they were generating tens of thousands of internet leads. They were processing those leads. They were scheduling appointments. They were making delinquency phone calls. They were doing everything that a property manager says they're going to do, but never actually has the time to do it, right?
Yeah.
They were doing all of those things. And the property managers were just thankful because I wasn't taking any money from them. I wasn't telling them, hey, I'm doing all this extra work, so I'm going to cut the amount of money I'm giving you. So they were just in a situation of true gratefulness because they had help, right?
That is so
For me,
brilliant.
it was billing 20,000 to a property and raising NOI by 100,000 a year, right? And what's the beautiful thing is this: the way net operating income works is, if you raise it by $100,000 every year for 3 or 4 years, and then you sell the property, on that last year when you sell the property, that 100,000 extra of NOI, if it gets you a 20x multiplier, that's what a 5 cap is. It's a 20x multiplier. So it's basically making $2 million that I wouldn't have made before, on top of all the cash flow that I'm making each year. So by doing that, it made property management much easier. And I didn't have to worry about property management because there's a bunch of really smart people in the Philippines that are making sure that every property stays occupied.
It's just such a smart move. I haven't met anybody that has pulled that off. What else you got? Something unconventional, something that you could think of to share that is very unconventional. Is there anything?
Well, the one thing I want to share with most people is this concept of built to rent. So one of the things that people in the industry understand is they believe that apartments are forever. And the answer is yes and no. Okay? Nothing is forever. Everything evolves, everything changes. So apartments are now undergoing a multi-decade shift. And that shift is called built to rent. Built to rent really are apartments, but they're horizontal apartments because you build a 200-unit community with townhomes or single-family homes. Initially, they built single-family homes. Now, after COVID, with supply chain issues, they're building townhomes because the cost of single-family homes is high. So everyone's building a bunch of townhomes, but they're designed for rent. So there's 250, homes in this community, townhomes, but every one of them is a renter, is a tenant. And this, in my mind, is the new Class A apartment complex. And no one has built a Class B apartment complex in this country for 15 years. Every single new construction property is now Class A because the cost of construction is too high to even bother building Class B, and the government doesn't give you any concessions. So if everyone in this country is only building Class A apartments, and built to rent is the new Class A apartments, can you imagine how different apartments, the landscape of apartments would look like in 10 years?
Yeah.
Where, it's what is happening is this transition where we are moving from just having high density apartment complexes to having high density apartment complexes and mid density, built to rent. And I think most people don't understand that this is built to rent today is where apartments were 10 years ago. So if I told Tejas, right, I'll move you back 10 years in time, Tejas would then basically beg and borrow every cent he had to buy every single apartment complex that he could possibly find and not sell any because he knows what they would cost in 2021. So why bother selling them? You just, you'll make 10x the profits by keeping them for 10 years, right? So that's where built to rent is. And I think not enough people are understanding that this is something that they need to get into because the margins on the apartment side obviously are shrinking and shrinking and shrinking further and further, right? I bought an apartment complex in 2017 or 18 for $55,000 a unit, Tejas. I sold it earlier this year for $185 a unit, right? So that's 3.5 times. And when you add leverage, basically we were making a shit ton of money, right? But the question is, whoever bought it from me for $185, I don't know how they're going to make money. So when you get to the point where you don't know how the buyer of your properties is even going to make money, and maybe they have some magical way that I haven't understood yet. But most people, my peers that are selling in this cycle, right? We're not buying, we're selling in this cycle. none of us understands how the buyers are going to make money. So the question is, if once you get to that point, the only answer to that question is, well, they'll probably hold 2 years longer than they're supposed to, and it'll hit their IRRs, but rent growth will make it up for them. If that's the answer, that's fine. Obviously, they're not losing their investor money, but the amount of return is going to come down substantially.
Sure.
And if that happens, then you really got to look at other avenues. And I would subscribe to you that build to rent is definitely one that our entire industry is now looking at. Many of my friends who laughed at me when I was doing build to rent in 2018, I see emails from them launching build to rent projects in.
We only got a couple more minutes, so I want to throw this at you. This whole concept out there of this new generation never owning a home and all the micro charges and being okay with like just every paycheck going to my monthly expenses. They're saying, no one's ever going to buy a house anymore and everyone's just going to be renting. Fits into the model. What do you think of that theory?
I know I don't subscribe to that particular theory. I think that the truth is that the millennials showed in 2019 and 2020 that they wanted to buy homes, and they did buy a bunch of them, right? The challenge was they bought them later and they bought them less than Generation X. And that left lots of room for you and me and other apartment owners to make money. And we made a lot of money as rents, went up. Bottom line is, I think people want to buy homes. I think that it's not that they don't want to buy homes. It's just that they realize that they're priced out, right? So so in 2019, 47% of Americans could buy a median home. Today, it's 20%. And I think it'll get back to 25 or 26% as single family homes go down. But 26% to 47%, you realize that 20% difference is 15 million households.
Wow.
And I can assure you, we did not build 15 million single family and multifamily units in the last 3 years. We didn't even build 5 million. So as inflation takes hold, it is giving a new tailwind to apartments and to any forms of rental, because a very large number of households that had the opportunity to buy single family homes in 2019 doesn't have the opportunity anymore. And unless there is a massive crash of values by 30 or 40%, they're priced out forever. They're priced out for the next 20 years. So these people could have gone either way, and they went the rental way. And now we have them as renters for the next several decades.
It's really great to hear you sum this up more eloquently than most. It's really, really. How do I work with you, or how does somebody get an opportunity to invest in you?
The best way to engage with us actually is to look at our data. You can just Google my name. I happen to be the only Neil Bawa on the World Wide Web. So just NEAL space BAWA, hit enter. If you want to look at the data that we publish, we have about 30,000 people following the data that we publish. The biggest tranche comes in January when we look at new data and publish kind of our thoughts of where the economy is going. You can go to multifamilyu.com. So that's Multifamily University, multifamily followed by the letter u.com. And that's you'll see our projects there, even though most of what multifamilyu.com is just webinars. We do 20 or 30 of them every year. I'm actually doing one tomorrow with 2,000 people signed up that is basically about the economy. So it's really not about real estate, but the economy is tied to real estate very strongly. So we have a webinar on whether the world economy is about to crash. So that'll be an interesting one. So I think that's the best way for you to engage with us. We like the slow engagement methodology. So as people walk in and talk to us, our first thing is not to say, well, we have a project open, because most of the time we don't have any projects open. They tend to come and go very quickly. They tend to open only for a week or two. But we like to engage you and make you understand our philosophy, why we do the things that we do, why we believe that rentals are a good place to be in, even though it's evolving. And once you understand that, I think you're in a better place to make a decision on whether we're a good fit or not.
Well, we will have all that information in the show notes. Everyone, REI MBA, make sure you check this out. Neil, you've been amazing. Thank you so much.
Thanks for having me on the show.
Definitely. It's Real Estate Investor MBA, rei.mba. We have the transcript for Neil as well. If you don't want to listen to us or watch us, you can read about us. But again, Neil, thank you so much.
Thanks.